Hi, everyone. Thanks very much for joining us this morning for our Consultant Fireside. My name is Lindsay Gobin, and I support our national accounts and institutional sales channels. Today, I have with me Corrado Russo, Managing Partner of Real Estate here at Hazelview Investments. I think we can dive right into it today by agreeing that there are just so many different variables happening right now in the economy. And what we want to speak to today specifically is real estate, how it's impacting real estate. What are we seeing out there? How are these different factors, whether it be rising rates, inflation, economic recession, regional bank bankruptcies, how are they impacting different types of real estate, both public and private? So what we thought we would do to help answer some of those questions is go over some of the main themes we're being asked by clients and consultants every day. Let's run through a few of those frequently asked questions, and we'll provide a slide or two on each of them. Please feel free to interrupt throughout, and we'll get through those and we'll open it up to Q&A. So on that, can you speak to how some of these different variables are creating dislocation? And maybe let's start with public versus private. We get this question all of the time. In public real estate, is public real estate the same as private real estate? Do they behave differently from time to time? And how do we think about it as an organization that does both public and private real estate under one roof?
Thanks, Lindsay, and thanks everyone for joining. Appreciate your time, and feel free to ask any questions throughout. So yeah, what I did is took some of the questions that Lindsay's talking about and put a slide or two to sort of speak to some of the data points that we're seeing out there, and put some numbers to all of the thought process and opinions that we see out in the market. So hopefully that'll give you sort of a starter in terms of the discussion, and then obviously happy to dive in a little deeper in anything you want to, or if you have any questions or tangents that you want to go on, we're happy to do that as well. Look, first off, on the dislocations, the public versus private, I mean, this is the biggest dislocation that we're seeing right now, obviously. And it begs the question, who's right? Is it the public or is it the private side? To sort of start with your initial question as to, is public real estate, private real estate, are they the same? Are they not? How do they behave? I mean, the answer is they are the same. At the underlying core, it's bricks and mortar that's leased to tenants, and they collect rent and they have expenses, and the net cash flow comes to us in the form of dividends and distribution. So they are real estate. It's really a function of the wrapper. But having said that, because you have daily price discovery, they do behave a little differently. Because of price discovery, you have the ability to walk and sell at any point in time. You don't run a long, lengthy process like you would on the private side. And because of that, you do get these dislocations because the public markets will price in different things much quicker than, much quicker than obviously the private side will. So what we have seen, and just put a little chart here, is that over time, public real estate does track private real estate very well. But in the near term, it moves and is more volatile relative to that private line. So not surprisingly, you see that smooth effect over the long term for private real estate, and the trend line of public centers and gravitates around that private line, but you do get these big locations, and you've seen some of the three largest that we've seen: financial crisis, going to COVID, and obviously where we are now. And ironically, this dislocation is actually bigger today than it was in COVID and even in the financial crisis, because what we did see in the financial crisis, the private valuations started to come down, and obviously, jury's still out in terms of how the top line or the private real estate valuations play out over the next 12 to 36 months.
Okay, so let's put some numbers on that, Corrado. What is the actual discount to spot NAV today? And have we seen these kinds of dislocations in the past, but to this magnitude? And also, do you have some historical analysis you can point to?
Yeah, so there's lots of sort of data you can look at. We've put one here that UBS has tracked over time. We use this one because they've got global. We tried to use some third-party information as well. I'm happy to talk about, and I think we will later on, about our opinions on where NAV is going, because I think, in my view, that's more relevant than where NAV is today. And we're all going to have our own opinions as to how NAV moves over the next 3 years and how it might be impacted by all the macroeconomic variables that we see changing today. And we also are going to have our view on what those macroeconomic variables will do over the next 3 years, and how they might impact NAV. So today we're sitting at a 24% discount. That discount is, relatively large. We did see for a very brief period bigger discounts to that in COVID times, and then as you see, they quickly snap back. And we also saw that in the financial crisis. But we've been here before. This isn't as unusual as you might think. You see over the last 30, 40 years, this has happened 7 or 8 times. That we've seen sort of mid 20% type discounts. The good news is, at least from the public perspective, that public real estate quickly finds the bottom. Historically, it has been very quick to sort of reset to where the new valuation should be, and then sort of continues to climb from there. Typically, it climbs from there because you see M&A activity as the private participants start to look into the public world and buy real estate at a discount that's on sale. Or you might see the private line obviously come down as well, and that will close that discount. So, obviously that begs the question of what we're going to see this time around, and I'm happy to give my thoughts on that. But yeah, that's where we're sitting today, is about a 24%, and that's obviously global, and might be different depending on the geography of the sector.
Now, just as a follow-up to that, in terms of these discounts, obviously this does speak to global listed real estate as a whole. If you were to break it down by different countries, are you seeing different discounts within countries, or are they staying relatively consistent? Maybe you can speak to how they might differ across geographies and potentially why.
Yeah, they actually do differ. And we put some data here in terms of the premiums and discounts to NAV, and I also added some other data, which I'll get to as well. But yeah, the discounts are pretty different across the different geographies. I mean, the consistency is that everything's trading at a discount right now around the world, in every market. But obviously, certain markets trade at a bigger discount. Europe is one of the biggest discounts, driven by Germany and France. Not surprisingly, obviously, given that it's not only about the monetary policy woes, higher interest rates, and the potential for recession that's happening in the Western world, but obviously the war happening in Ukraine is sort of impacting that part of the world as well. So you've sort of got two major issues going on there. So there you're going to get the biggest discounts. The irony in Germany is it's predominantly driven by residential or multifamily, which is amongst the most stable fundamentally globally, but obviously, given the interest rate rises and the potential concerns and regulatory risk there, we're seeing some bigger discounts. The U.S. is obviously at a big discount as well, although it's started to see NAVs, at least in the private side, start to come down. So that's why you're seeing a bit of a smaller discount there. UK continues to be high. Hong Kong's a bit of a different animal. The discount is very high at 43%, but it's been high for a while now. There's obviously other underlying things that are leading to that discount there, starting from pre-COVID days in terms of the protests around the amalgamation back into China and what that might mean for Hong Kong prospects in terms of being the financial gateway into mainland China, and for China, the gateway into the Western world. So there's other things to sort of consider there. Also, the way that Hong Kong companies are held in terms of large families that can have a controlling interest or multiple voting. The ability to sort of surface that NAV is a little more difficult because of that corporate structure. So that can lead to permanent discounts that you be careful of. And then obviously in Japan, you have to break out the market there. The J-REITs actually have relatively low discount because they're very plain vanilla, bricks and mortar, relatively new product, whereas the developers who sort of build this stuff and then sell it to the REITs obviously trading at a much bigger discount, which is likely unwarranted in terms of if you look at the underlying quality there. But you can see the theme, right? The areas of the world that have been more impacted by inflationary pressures and have seen interest rates go higher are trading at bigger discounts, and obviously, by product or business type developers, obviously trading at bigger discounts than pure REITs as well. The other thing I want to point out, though, in terms of this discount, and again, point you back to, we've seen these discounts before, but what's, and you hate to use the term, what's different this time, but I do want to highlight the balance sheets of publicly traded companies this time around. It's exceptionally different than what we saw in the financial crisis. In the financial crisis, it was quite common to see debt to enterprise value in the 60s, 70% range, even as high as 80% for certain companies. And so obviously when you see a crack in the armor in terms of the banking situation, and like we're seeing today, that can weigh heavily on real estate and publicly traded companies, obviously, that have high debt as well. But the balance sheets today are so much more solid in terms of having low leverage, low level of maturity, and locked in rates for longer. So I think they're in so much better shape in terms of the ability to survive. And so when I look at those discounts being similar to the financial crisis, and you look at the survivability of these companies given the debt levels, it feels a little harsh to me. The other thing I'd point out is fundamentals are still very strong for real estate. And of course, that might differ by sector, but if you look at the overall industry, this is a sort of, and again, this is third-party information in terms of expected EPS growth for 23 and 24. We're not talking about 21 and 22, which we know were strong fundamental years. Obviously, the question mark is what happens to fundamentals as we go into a weakening economy. And, I think what's happened is you've seen sell side sort of bring down their expectations for growth. But again, because of the demand supply and supply being turned off in many of the industries, you're still seeing a pretty healthy demand, and that's leading to pretty good EPS growth. So you've got this big discount to NAV, you've got a solid balance sheet, and you still got growth going forward. So it seems like a pretty opportune time from my perspective in terms of starting to think about different ways to access real estate and how you take advantage of the uncertainty that we're seeing out there rather than playing defense.
So Corrado, you talked about something interesting on the last slide that I wouldn't mind, which was developers, which I wouldn't mind diving a bit deeper into. So how should we think about the discount across various segments or sectors of real estate?
Yeah, so I'll start on developers versus REITs, and then we can get into the sectors. I mean, obviously, developers, I'm sure everyone on this call is familiar with what's happened to costs and inflation and how that's impacting returns on new development projects. Obviously, costs are going up, and there's uncertainty around what the residual value might be. So that uncertainty, obviously, in the public markets is weighing quite heavily on the underlying stock prices. So effectively, what the market is saying is, look, anyone that has leverage, you can see it from Germany discounts, right? 70% leverage, and anybody who has recurring income risk, I'm going to overly punish. And I'm going to take a wait and see attitude. And, the only thing that's going to change my mind is quarter after quarter. If I start to see that there is a consistency there and things are not as bad as I think, then I'll start to think about coming back in. But, it's not surprising that the developers would be more harshly hit. And then if you turn to the types of real estate, again, it's not surprising in terms of what you might see there as well. Office has the biggest discounts to NAV. We'll all have an opinion on the office market over the next, 5 to 10 years, what work from home trends and how that might play out. We can all go back and forth. I'm happy to share mine as well. But it doesn't change the fact that it is the sector that is seeing the most amount of uncertainty in terms of the long-term fundamentals of that sector. So that's why you're seeing the bigger discounts to NAV, and you're also seeing the least amount of expected growth in that sector as well. And that's obviously the price declines is starting to impact the enterprise value and the leverage ratios. And obviously what's happening with the banking system, there's a major concern from given the regional banks, for example, in the US, are they going to be able to refinance debt on these office buildings when it comes up? Because it is the number one sector that's on the watch list of regional banks. And as they pull back in terms of the resources available for financing, this might be one of the sectors that could get hurt. Moving down the list, residential is a little surprising, but I think you have to take that with a grain of salt. Again, this is the global average. If you were to break that out by with sectors within countries, you might see that a little different. That's really driven by Germany. And you saw the big discounts in Germany, which is a large residentially driven market. And again, because of the leverage of being 70%, I think that's what's punishing them more than not. And obviously cap rates, given the negative interest rate environment that we saw over the last couple of years, were extremely low. And so any potential rise in cap rates will have a disproportionate impact given how low cap rates are, and given the leverage, there is a sort of exaggerated potential effect there to come, although the fundamentals are obviously very safe. Hotels are actually a little surprising in terms of the least amount of discount. Typically, when you see this uncertainty, hotels are one of the ones that get hurt the most because it's most economically sensitive in terms of its recurring income stream. I mean, their average duration contract is 1 day. So, they've got to reinvent themselves every day. But obviously, given COVID and the recovery and the incestuous demand for leisure travel, which continues to be strong, I think that's what's holding up hotels. And you didn't see NAVs grow as aggressively through the last cycle. So I think that's part of it as well. You never got to very high levels of private valuations. So you're not seeing, as big a discount there. So that's sort of how they play out by sector. And obviously, we just focus on the traditional sectors here. What we're seeing in the public markets versus private, there's a much more growing interest in non-traditional asset classes, data centers, cell towers, self-storage, bigger proponent of healthcare, hospitals, medical office buildings, that sort of thing, life science buildings, which actually have a significantly higher growth trajectory. And I think that's why they're seeing some of the discounts lower, other than I'd say the more tech-oriented ones like cell towers and data centers, which are getting caught up in the broader tech sort of wreck that we saw most of last year, but we're obviously starting to see a reversal of that as well.
Okay, so you've spoken so far about spot NAVs. What we have yet to address is the elephant in the room, which I think is fundamentally the reason we dreamed up this call in the first place, Corrado. What happened if private market valuations come down versus public go up? How are you underwriting that if you essentially believe there's an opportunity in public real estate? And how do you think that disconnect plays out? And then on top of that, where do you think the true return potential is?
Yeah, so I think that's the only question that matters here at the end of the day. I mean, it's all about how are things going to play out, right? That the first slide we put up, and maybe if we can go to the next slide, we'll start to see that. But the first slide we put up on this call was that sort of public to private line, right? And we see the discount. And so what we've learned so far is we're at a big discount. We've seen it before, but historically that public price always comes back to private. And it typically happens over a year or two. What we don't know though is how much of the top line, private, comes down versus the bottom line, publics, go up, and where do they intersect at the end of the day? And so this was our attempt to try to answer that question. So what we've done here is rather than focus on spot NAVs, we have focused on forward-looking NAVs. And then we've said, where do we think that top line will go? And then what's the upside on the public side to that line, to that trend line? And what's interesting is, so what the exercise we did was we went through every company in our universe. There's about 450 of them. And over the last 3 or 4 months, we've been working to re-underwrite all of our companies, the underlying portfolios, by market sector, and looking at where we think rents will go, occupancy will go, where we think cap rates will go. And so we're trying to build in where we think ultimately the risk-free rate is going to end up, where we think inflation or rental growth will end up, where we think GDP growth will end up. So, I think the environment we saw over the last couple of years was unsustainable in terms of low interest rates and high inflation. The environment that we're seeing today is likely a bit unsustainable in terms of very high interest rates at the front end of the curve, an inverted yield curve, yet still strong inflation and strong economic activity. And so we know that's likely unsustainable and something has to break there. And we're already seeing signs of things breaking. And so ultimately, if we think about where do we end up, try to take into account the new macroeconomic variables and the changing environment and how that might impact our companies longer term. We looked at that and then we said, okay, where does that upside now play out? And so what we're seeing is that when you do that, you get to a 22% discount to intrinsic value. I use intrinsic value rather than NEV because we have two ways of looking at the world, both in terms of a discount to NEV and in terms of a discounted cash flow. So we've looked at it both ways and blended those two numbers together to get to what we believe the discount to intrinsic value is. And a couple of things play out. One, it's interesting that the discount is still as high as the spot NAV. And so let me explain that a little bit more because I think that takes some explanation. That's not to say we haven't moved cap rates higher. That's not to say we haven't brought rents down for certain sectors like office. That's not to say we don't think there's a bump in the road potentially on vacancy, for example, as the economy starts to weaken. We have put all that in. But again, when you look at the fundamentals, you look at the demand supply picture and supply coming down, demand staying relatively high. You look at where in-place rents are versus, we've seen a spike in rent for certain sectors like industrial, multifamily, but the in-place rents haven't caught up to where market rents are today. So there's still an implied mark to market there. So even if rents flatten out or come down a bit, in certain sectors, for example, like industrial, there's still a significant amount of growth. So it's the sort of classic example here where the numerator is growing to offset what's happening in the denominator. So even if you get a bit higher cap rates because you're capping higher income stream and in some cases a higher quality income stream, and we've seen a lot of companies start to shed lower productive assets and investing in sort of higher quality assets, and that's been happening over the last 3 years. So that and they've been doing more value add type opportunities as well. So that's driving that top line growth as well. So this is where we sit when all is said and done to try to get a sense of, for those private investors on the call, where's stabilized NAV? Where are stabilized values? When I get through all the noise and I get to a stabilized NOI 3 years from now, and I put what I believe is a stabilized cap rate on that, where do I get in terms of valuations and where's the upside to that? So, when we look at that and you turn to the second column there, you're effectively looking at about a 28% upside. Now, that's different by region, but the other thing I point out is while the overall number is similar in that 22% discount, which implies 28% or 30% upside when you add the dividend yield, by region, you can see that the disparity is much tighter. So you don't have as big a differentiation by market when you start to do it that way. And so obviously that tells you that there is some efficiencies happening in the market, and where you have bigger discounts to spot NAV, that's because NAV is likely to come down more in those markets. So when you look at these stabilized numbers, you see that it's pretty consistent in that sort of 15 to 25% discount to NAV. And yeah, as I pointed out earlier, you add your dividend yield, we're seeing about 32% upside to that new intrinsic value that we see 3 years from now. And again, I want to keep in mind that that underwrites the current expected macroeconomic activity, right? So obviously, if rates come down from these levels or more than expected, if inflation does get in check, but still positive in the 2-3%, 4% range, and he gets, a softer landing, then I think these numbers can be better than that. But this is based on sort of the macro picture where we are today, because the point was trying to underwrite and be conservative on how this might play out.
So what changes? How do we change that? You've got that, you know what you potentially feel the upside is from here. What factors do we think are actually going to close that gap, and what should we be looking out for?
Yeah, it's not rocket science, right? There's a few things that I think need to happen for those lines to converge. Obviously, interest rate headwinds need to dissipate. At a minimum, we have to see rates stop going up. People need to be able to ring fence where interest rates are, understand and be able to underwrite what their financing costs are going to be, and then figure out, what they can pay for real estate to, make the economics work in terms of buying new assets. So I think we need to see interest rate headwinds dissipate. I think, the expectation is that rates have peaked with the latest 25 points. Let's say in the US and Canada, we've seen the central bank go on pause already. The expectation is that we're nearer to the end than we are at the beginning, of course. And that is expected to have a significant impact on economic activity. Jury is out how quickly it will impact unemployment. But all those are the major factors, and obviously we'll see what happens with inflation. But those are the major factors that's going to lead central banks to not only stop rising rates, but potentially cut rates, as we may see a quicker deterioration in economic activity than we might expect. So that more to come on that side. And then the other thing I'd say is on the REIT earnings. I think this is, in my view, probably the most misunderstood aspect of real estate today. Earnings expectations are still good. Fundamentals are still pretty good. I mean, they were great. They're probably not going to be great going forward, but they're probably still going to be good. And there's a lot of catch up from today to catch up to the great that we've had in the past. So I think as we get economic slowdown and people start to look for areas that have resiliency in income and are less economically sensitive, because you have contractual rent obligations here, I think you'll see capital start to come back to real estate and be interested in that space. So obviously that has to play out. We have to see that earnings growth become actuals rather than expectations. And that'll be part that would improve the real estate space as well. And then lastly, at least for the public side, relative to the private side, I think you see M&A. This has traditionally been the biggest factor that has closed NAVs historically, has been M&A. Predominantly private players, you think of the big guys out there on the private equity side, as well as pension funds that start to look at these publicly traded companies and take advantage of what you're seeing there, right? Why would I pay fair price on the private side when I can pay 20% lower on the public side? I'm going to get better returns. I got a better entry position. And so you've already started to see that. We've seen a significant amount of activity in the back half of 2022. We saw a couple already happen in 2023 as well. So it's starting to happen. And so we've seen pretty big premiums paid for these. So I think that's a function of, people thinking that the private valuations are more accurate than the public valuations, given how large the premiums have been on these acquisitions. But it hasn't carried through yet. The markets are still volatile. And I think you need to see, number one on this slide, really start to calm down before you can see the consistent, recovery in valuations on the public side as these M&As continue to have more activity through the year, and I think they will continue to have more activity through the year. So I think these are the three main things you need to sort of see to have those lines converge.
Okay, so that's how you think things are going to play out maybe in the next 18, 24, 36 months. Obviously, in the interim, there's a plethora of uncertainty and moving pieces and potential volatility. Do you think that there are some sectors that have a greater level of risk in the near term versus others? And how would you kind of rank some of the best and worst sectors given the uncertainty in the current economic environment?
Yeah, it's a great question, and there's a lot of moving pieces there. I mean, obviously, yeah, you start with fundamentals and where valuations might be ultimately, but you have to sort of also look at what's priced in and what's not. Obviously, if we think about the backdrop of being an economic slowdown, a constrained financing environment where there's going to be scarcity of capital, you have to be worried about office fundamentals and the ability for office to be able to renew. So that I think I would be cautious there. And if you're going to invest in office, you've got to have it's got to be an opportunistic trade. That you think there's an ability to create an amenity package that's going to steal market share from others in the market. But I do think, depending on the pricing, there could be some opportunities there. Hotels, obviously, I think the discount is not that large and fundamentals have been great. And if you're going to get an economic slowdown, it's hard to see how those fundamentals hold up as well as they have. Having said that, business travel is just starting to come back. Asia's just starting to open up. So there's also a case that those fundamentals could continue to be strong. Multifamily obviously typically does, I think will do well in this environment, even though historically, at least in the US, it's been more economically sensitive. In Canada, it's been less economically sensitive, as well as in Europe, less economically sensitive. But I think when I look at the bigger picture here, we have a housing shortage pretty much everywhere on the planet. And it's hard to see that going away anytime soon. So obviously, real estate's pretty simple. It's about demand supply. And so you've got a situation here where it's, ever getting more difficult to produce more supply, and yet demand is significantly higher than that. So I think the fundamentals there are great longer term, and we should take advantage of some of the pricing that we're seeing. And then you get into some of the specialty industries like cell towers, data centers, life sciences. Those actually are pretty exciting from my perspective. I think you've got some pretty good earnings growth. You've got long-term secular tailwinds in those industries, and you can take advantage of the whole tech sort of out of favor, maybe not at the moment, but over the last several months. I think there's some pretty good attractive entry points there and good healthy growth over the long term. And like I said, the balance sheets are just so strong today relative to what we've seen in the past. So I take a lot of comfort in that as well. And then other sectors, thinking out of the box in terms of housing, getting away from multifamily, but manufactured homes, single family rentals, student housing, there's some really exciting stuff going on there as well. Again, got to be careful how much you pay for that upside, but if you can get in at good attractive levels, I think those could be some significant areas of excitement as well.
Okay, well, let's touch on timing. How should we think about timing? And is there anything we can point to maybe historically to try and guide us as to how the timing might work out to get to that intersection point?
Yeah, you've hit on the area that I'm probably least confident about. I mean, all of this is obviously a crystal ball, and I've done my best to sort of give our thoughts on how we think things could play out here. The timing is the tough part, right? It's ultimately it's going to depend on how aggressive central banks stick to their long-term inflation targets and how quickly they want to bring those targets down, right? Using the US as an example, I don't think we'll ever get away from the language around a 2% target. I'm I'm a little comforted by the fact that they haven't given any timelines. So that could be 2% in 5 years, 7 years, not necessarily in 1 or 2, which I think could be, a dramatic crisis if they tried to do that. So obviously it's going to depend on what happens with interest rates, how quickly we stop raising rates, how quickly they potentially come down. Because I do think rates have to come down. Because I think there's obviously, and we're seeing this in regional banks, things will break even at the current levels, let alone higher levels. But having said that, if you look at these 3 charts, I put a couple of charts here that just look at historically. Let's try to look at history to get an answer. What's happened in the past. And historically, it's about a year or 2 that closes. So that's the good news. There's a very, very quick reset and then a couple years to sort of, blend this all out. That's the good news from the public side. The other good news is, it ramps up pretty quickly and we'll probably hit the bottom in terms of valuations on the public side. On the private side, the news is a little more mixed. If you look historically, we've had, situations where there's been, quite a deep reset in private valuations in the global financial crisis, for example. But again, that was predominantly driven by the US. Canada didn't see the same level of declines in terms of NAV. Obviously, we'll see if this time is different. But you saw the early 90s and the recession that happened there. Very, very mild changes to private real estate. That you saw in that. And then if you look at COVID, there was effectively, not only was there no change, but we continued to climb higher in the private valuation side. So I think on the private side, I think the jury's still out. I think it really depends on the asset type. I think it depends on the location. I think it depends on the local demand supply factors. And I think it depends on the type of business plan with respect to the real estate. And what I mean by that is, if you have core real estate today, you have very long-term leases, you're fully occupied, you've got high credit quality tenants, you've got renovated product, you're effectively the best of the best real estate. Unfortunately, I think what that means is you're kind of a bond. And as we've seen, because it's great real estate and very safe and low risk, cap rates for that type of product have been quite low. As interest rates have gone down, it's become the alternative to income because you couldn't get income in the fixed income market. And today you can get income in GICs in a risk-free rate, let alone having to go to the fixed income market and take on corporate bonds. So I think that type of real estate could be more challenged. Because you're effectively going to behave like a bond, versus if you've been in value add funds, for example, where you're buy, fix, sell, you've bought things at a discount, you're changing the product, you're doing something to the asset to improve it, to take it to a new category, either a B asset to an A asset. And you're changing the amenity package, the product offering, so that you can, take your property from $20 to $30 rents, $30 to $40 rents. I think to me that you're going to be a lot less sensitive to what's happening on interest rates, because you've shifted your composition of return more to cap gains rather than income. And that cap gain should be less sensitive to what you're seeing in interest rates, and that growth, that numerator effect in terms of valuing real estate should offset potential rise in cost of capital in your denominator. And then the other thing I'd say, which I think is exciting us from the private side, is just seeing the ability to densify. The land entitlement type strategies, or buying assets that have low density and improving the density, working with the city, I still think we'll do quite fine, because again, I think if you're doing it in the right areas, like multifamily, like industrial, for example, or mixed use, where there is still strong demand and we have a shortage, when you're taking something that is 2 stories and you're converting it to something that's 12, 20, 30 stories, the value creation on those air rights dwarfs anything to do with the income. So the cap rate becomes irrelevant in those situations. So I think it really depends on the type of private real estate that you're in. But having said that, when you look at the public side, I mean, the good news there is, you likely have found the bottom. The next move is central banks to become more accommodating, or at least stop being as unaccommodating as they have been. And when you see that, you typically see that rise back to NAV over a couple of years. And what this also shows you is there's typically an overshoot as well. So, that's sort of how I'm thinking about the real estate space today.
Great. Well, you touched on some really important themes today, Corrado. We've got a little bit of time left, so maybe we'll turn it over to the audience, see if there are any additional questions they'd like to pose to you. Give everybody a minute or two to write some down if there's any.
Don't be shy. I'm sure there's got to be more controversy here.
Don't be shy, consultants. We know you're not shy.
All right. Well, if there's no questions, like I said, I mean, anything comes up afterwards, or there's something you wanted to ask, but you didn't want to do it on this call, you want to reach out to us, feel free to reach out to Lindsay. We'd be happy to, set up some time to go over anything else.
Corrado, actually, we did get one question in.
Yeah.
How should we think about the impact of the banking crisis?
Yeah, I mean, it's going to be an issue, and I think we really have to take that into consideration. I think the biggest direct link to commercial real estate is going to be, the ability to access new financing for any projects or acquisitions that you want to do is going to be limited. But I think even on renewals, there could be potential impacts. So I think this is something that we spent a lot of time thinking about. What's interesting, if you look at the US regional banks, they're responsible for about 70 to 80% of the loans to commercial real estate, which is obviously extremely high. And commercial real estate represents about 30 to 40% of their loan book. So those, the banking crisis, regional banking crisis, specifically in the US currently, and obviously, things are playing out in Europe as well with Credit Suisse, has a really direct link to commercial real estate. And again, as I've spent a lot of time over the last couple of weeks speaking to banking analysts and trying to understand how they're thinking about the space, being on calls with regional banks and CEOs and CFOs. This is top of mind for them as well. And so what you're going to see from their perspective is those private owners and those public companies that have great long-standing relationships with banks and do a lot of business, not only in the commercial space, but across other parts of their business, will be fine. They're going to take care of their existing clients first. But unfortunately, I think some of these smaller owners or smaller companies may have a tough time as they pull back overall lending. They're going to be very selective on who they lend to. And then by property type, they're going to be very selective as well. And so number one on their list is to reduce office. I think office is going to be the most challenged in terms of the ability to refinance on renewals. So I'd stay away from anything that has maturities over the next couple of years, for example. Make sure that you don't have any maturities. And if you do, there's probably, you're going to have to look for ways to access equity or pref equity, or high level of mezzanine debt. So I think that's an area that could be of concern. I think the flip side is who benefits is likely residential, multifamily. Obviously, given the agency debt that you have there, whether it's Fannie and Freddie in the US, CMHC here, and we saw this in the financial crisis, it is the sector that has the most access to financing. And in this environment, obviously, that's going to be of huge benefit to them. And then all the other sectors are sort of in between. Retail is going to be very specific to the asset class. Healthcare and triple net will be okay because they have such a strong recurring income stream. So I think they'll be fine. Hotel, I think, is where the jury's out. I think there's mixed feelings in terms of how to think about that. There's kind of the the view that if the economy slowed down, if we look at history, hotels have to slow down, but then the fundamentals are so strong today. So it's really what your view of the future is there. But yeah, the banking crisis is quite significant. I would throw out one piece of information maybe for the group here that I was sort of thinking about last week as I was having all these calls. In the financial crisis, we saw a lot of blend and extend, kick the can down the road. The banks did not want to write off commercial loans. So their view is, I'm not going to foreclose or put an owner in default, take over that asset, and then have to write down the loans. If I write down the loans, I reduce my reserves. And if I reduce my reserves, I have to pull back loans even more because of the amount of leverage that I have as a bank. And so they're very willing to blend and extend, or, as people affectionately called it, pretend and extend. It's going to be a little harder this time around to do that because of the regulatory changes that we saw after the financial crisis. There is what's called a risk capital charge. And so if you renew a loan that is underwater in terms of the fair market value is below the amount of the loan, there are massive risk capital charges that are attached to the bank's reserves, such that it makes it economically unviable to pretend and extend. And so they may be forced to call some of those loans in to default on some of these assets. So I think that's more reason to make sure you're very careful in terms of the exposure that you get into. The relationships that you have, the maturity schedules, and the asset class that you're involved in.
Great. Thanks very much, Corrado, for sharing so many of those valuable insights with us today, and to our audience for your participation. The slide deck and also the recording will be available to anyone who wants to review after this call. And as always, Corrado and our team here at Hazelview are at your disposal should you want to discuss any of these topics further. Thanks very much, everyone. Have a great day.
Thank you.